In this video, we are going to address a problem from Chapter 1 relating to cash versus accrual accounting. And before we dive into the problem, let's discuss some differences there are between cash and accrual accounting. When we talk about accrual accounting, we're trying to solve for net income. Accrual accounting agrees with the matching principle that is required under the Generally Accepted Accounting Principles, or GAAP. The matching principle tells us that revenues are recognized in the period they are earned and expenses are recognized in the period they are incurred, regardless of whether cash has been received or paid. On the other hand, when we talk about cash accounting, we're trying to solve for the net operating cash flow, or more generally, our cash balance. And this is the opposite of the matching principle, because revenues are going to be recognized when they are received and expenses are recognized when they are paid. So revenues ultimately in cash accounting are going to be cash receipts, and expenses would be our cash disbursements. Another way of saying that is also our cash inflows and our cash outflows. Ultimately, it doesn't matter under cash accounting when the revenues are earned and the expenses are incurred, because it's all about the movement of cash. So revenues and expenses under cash accounting will not necessarily match the period they were earned or incurred. Okay, so we see looking at the problem here that it's asking us to compute net income for the first year and the cash balance at the end of the first year for Alpaca Corporation. So let's go ahead and start by solving net income. And first, let's look at the formula here I put up below. Net income is our revenues minus expenses, which equals income before taxes. Then we subtract the income tax, and that will give us our net income. So now let's solve for net income from the problem. In the first sentence, we see Twice Corporation had revenues of $200,000 in its first year of operations. So on our income statement, we will record $200,000 for revenue. Next, says the company has not collected on $20,000 of its sales and still owes $25,000 on $70,000 of merchandise it purchased. So when it says the company has not collected on $20,000 of its sales and still owes $25,000, that doesn't affect accrual accounting. It affects cash accounting. So what we're worried about here is the $70,000 of merchandise it purchased. That's inventory it purchased. And in the next sentence, we see the company had no inventory on hand at the end of the year, which tells us of that $70,000 of inventory it purchased, it then sold all of it as well. So that would have been a debit to cost of goods sold, which is an expense. So we're going to record $70,000 for cost of goods sold on our income statement. Next, we see the company paid $15,000 in salaries. That will be another expense. Then we have the owners invested $20,000 in the business and $20,000 was borrowed on a 5-year note. Those are both balance sheet accounts that will not affect our income statement. Next, we see the company paid $2,000 in interest. That was the amount owed for the year. So we're going to record that $2,000 interest that we incurred for the year as an expense. Then we see the company also paid $6,000 for a 2-year insurance policy on the first day of business. Now under accrual accounting, we're only going to record $3,000 of that policy because that's all we incurred for the year. So on our income statement, we'll record $3,000. And now, if we add all those expenses up, that'll give us $90,000. And we'll subtract that from our revenues to get our income before taxes, which will be $110,000. Now we see at the end of the problem that we have a 40% income tax rate. So we're going to take that $110,000 of income before taxes and multiply it by 40%. And that will give you $44,000 of income tax to be paid. And now if we subtract the $110,000 minus our $44,000, that will give us our net income of $66,000. Now that we have net income, we'll be solving for the cash balance through cash accounting, and I'll put that formula here, and that is the cash receipts or cash inflows minus cash disbursements or cash outflows, which equals our cash balance. Now let's go ahead and go through the problem and start by first finding our cash receipts. In the first sentence, again, we have revenues of $200,000 in the first year of operations. However, it says the company has not collected on $20,000 of its sales. So that tells us of the $200,000 it earned in revenues, it still has not collected $20,000 of cash. So therefore, there's only $180,000 of cash we have received as a receipt from sales revenue. So let me show you how we will record this. We're going to write $200,000 for sales revenue. And then we will subtract $20,000 of an accounts receivable because that's the amount we haven't collected. And that will give us our net of cash we've collected from sales revenue to be $180,000. Our next cash receipt comes down here where it says owners invested $20,000 in the business. So since they paid the business cash of $20,000, we will record that as a cash receipt of $20,000. Next, they also borrowed a 5-year note at $20,000. So since we borrowed $20,000, that's a cash receipt, money that came into the business, we will record that also as a cash receipt of $20,000. So that will give us our total cash receipts of $220,000. Now let's find our cash disbursements. The first thing we see with cash disbursements is the $70,000 of merchandise we purchased. However, the difference between cash and accrual accounting is that we're only going to account for $45,000 because we still owe $25,000, and that's an accounts payable. But under cash accounting, we're only recognizing the cash we dispersed. So that's going to be the $70,000 minus the $25,000. So we'll report that as $70,000 in purchases, less the $25,000 that's an accounts payable of money we still owe, which will give us a net of $45,000 we dispersed from purchases. The next thing we see is we paid out $15,000 in salaries. So we'll record that as a cash disbursement. Then we have the company paid the $2,000 in interest. That was the amount owed for the year. So we'll record $2,000 in interest as a cash disbursement. Now we have the $6,000 that we paid for a 2-year insurance policy on the first day of business. And under cash accounting, we are going to record $6,000 as a cash disbursement because we paid out all $6,000. Remember, it's all about the movement of cash. It doesn't matter what period it was incurred in. So we will record $6,000 as insurance paid. And the last thing we need to remember to record for cash disbursements is the taxes we calculated to be paid, which was $44,000. So if we add all of those numbers together, that's going to give us our total cash disbursements. And we will then subtract that from our cash receipts to get our ending cash balance. So the total cash disbursements is $112,000. So we'll put cash receipts over here of $220,000. We will subtract $112,000 of cash disbursements, and that will give us the cash balance of what we're looking for, which is $108,000.